Hello out there. You're welcome to my channel where we do our best to simplify the practice of quantity surveying. Thank you for staying tuned. Uh, in today's episode, we are going to be learning how to prepare a cash flow uh, document. As we all know, uh, the cash flow is an important document that is expected the quantity surveyor or the project manager of a construction site to make available uh, to their finance department for the purposes of planning. Because if this document is not available, this might lead to either disruption during the construction phase where uh, there will be no fund for the execution of this job of the job that will lead to either delays or lead to delay and the company might be penalized based on the condition of the contract. Say the condition of the contract stipulates that uh, for every day that you delay in delivering the project, there's a certain particular percentage that will be charged, that you'll be charged for that delay as damage. So you fall victim to that. So, but this document, once this document is made available, the department will see what will see on that document what your income is expected if it is monthly, if you pay if it is monthly income, what is expected, the company is expected to get every month, and what the corresponding expense to that money to that income that is expected to come in. So with this, the finance department will make the amount that you are expected to spend for this income to come in available for you for each month so that that delay will not occur. Uh, so as you can see on my screen, I have uh, a planning that I have done for some activities which are basically uh, under the substructure. These activities is what is expected of me to carry out for the next 5 weeks, which is 35 days. And in these 35 days, my assumption in the my assumption in this planning is that there are no weekends. You're going to work all through. It is a contract where it's on the speed lane where you needed to deliver in 35 days, excluding Sundays and Saturdays are not excluded. So you can see I have my activities lined up on my far left, and on my right hand side, the number of days allocated for each of these activities, it's indicated in yellow color. You can see the first item, which is a site installation. I said I am going to install by my program. I have 3 days to install my offices, my plant, and make sure that the site kickstarts. Then while because the job is on fast lane, I now said setting out will start immediately. Setting out and excavation will start immediately, and it's going to run for 7 days. And this also is assumed that the site has been cleared, topsoil has been removed, so you're just moving in to start your site installation and excavation, setting out. Then excavation will commence. Then the leveling and compacting will start 1 day after uh, uh, 1 day after excavation commences, because even though it is a job that will it is a job that is start to start, but there is a 1 day lagging between the two activities. One has to commence so that that area that was dug the previous day, the people responsible for the leveling and compacting will move in to that area and start compacting. Then the concrete also has a 1 day lagging between the 1 day lagging between the leveling and compacting. But for the reinforcement, you can see starting on day one. Why is it starting on day one? Because the reinforcement, you don't need a space in the areas they are excavating to start. You can start the preparatory work, you start cutting, you start bending, in readiness. You can even tie the mat. You can, so that once the blinding is cast, you can lift the mat, position it. After the surveyor must have given you the line, then you tie your starter columns, they align it, then the formwork can the sideboard for the base can commence, then casting will commence. So you see, I had the planning with their time lagged of 1 day intervals. Even though the most of the jobs are start to start, they have to have a day interval so that that activities will commence, even though it's not concluded. Then there will be space for the next activities to commence in that location. So, having said this, having prepared my planning based on this, and I've been able to achieve the 35 days, I'm not exceeding. If I'd done my planning and it's exceeding 35 days, so what I needed to do is now I begin to adjust. I begin to adjust so that I can bring back my planning to meet up the 35 days that the client has agreed. We have agreed with the client that we are going to complete the job. So, having said that, I will now open I'll now open this column where where I brought in the quantities, but in uh, in your planning, this amount uh, usually does not reflect the quantity. There are locations for where the quantity will reflect, because it is this quantity that you are using uh, to allocate days for the planning purposes. Say I have a 250 cubic meter of excavation to do, and it's for 7 days. So if for me now to attain this so for me to achieve this 250 cubic meter in these 7 days, which means I needed to do a 36, not less than 36 cubic meter daily. It can be more. If it is more, it is good for me. So that the days I have obstruction as a result of maybe uh, not favorable weather, or maybe there are workers on rest, those days that I have worked beyond the normal cubic meter I needed to achieve can cover up for those lost days. So, but I shouldn't dig less than this, but I can go more. Then also for leveling and compacting, I am having a 500 square meter, and it's expected that I will spend 5 days to do a 500 square meter of the leveling and compacting. Also for blinding concrete, I have a 80 cubic meter, and I have from the third to ninth, I'm supposed to blind. So if I divide the 80 by the number of days, I should be able to cast that number of cubic every day, so that I can achieve those days. So this planning now is just for the purposes of this exercise. So now, having explained how the quantity is used to prepare this planning, this figure now will be what I'm going to now split. I'll split this income amount, split it to reflect my planning, so that this figure will now, the amount of volume I'm expected to do on day one, the corresponding amount for that volume will be the amount I will get as income from this 7 million. Also day 2, day 3, day 4, and day 5. Then the same thing when I'm preparing my expense forecast, the same thing that the same percentages that I allocated to each of these activities according to my planning with what I'll still use to now spread this figure across. So having explained this, we shall now proceed to the first document, which is the income forecast. So what I did was is to bring these activities up here. Then I splitted the volume of I splitted this quantity. I splitted this quantity. Let me just put it here for the purposes of emphasis. I splitted this quantity according to these percentages. As you can see, I have my spreadsheet below, and it is still numbered in the same manner in which my planning is done. I have my day 1 to 7 and week 1, week 2, and all of that. So now I now splitted this quantity to say I'm going to do 10% of this quantity in day 1. And why am I doing 10% of this quantity in day 1? I could give several reasons. Because I am going to, it is a setting out and excavation. Say in day 1, the day I'm going to set out. And because of the setting out, I will not start excavation immediately. It is after setting out and check-ins are made before I can mobilize either the equipment, or if it is a manual excavation, I bring in the manual laborers that will dig that portion. So the activities will be less in day 1. So I have a 10% of this volume I will do in day 1. Then in day 2, I'm going to do a 25% of it. Day 3, I'll do 25. Day 4, I'll do 20. Day 6, day 5, I'll do 10. Day 6, I'll do 7. And day 8, I'm going to do 3. You remember I did said I could spread this 250 in proportionate in the same percentage across the 7 days. But if I am able to do, say, 25% for in day 2, 25% in day 3, 20% in day 4, it saves me from, say, if I was to apportion, say, 20% all through to day 7, that would give me the 100% of it. And now there were issues on site that I couldn't, maybe disruption as a result of the rains or workers unrest, I couldn't achieve it. Then, which means it's either I'm going to bring more people or my work will be late. But because I have done more jobs within this days, the previous days, even if I do less in subsequent days, I will still attain my 100% of the 250 in the 7th day. So I now use this percentage now to spread the volume across the whole the duration of the the project, which is 35 days. 35 days. Then for, say, the preliminaries, and mind us that as I am spreading these percentages, I have a control here to ensure that I did not exceed my percentages allocation does not exceed 100%. Because if it does exceed 100%, and I now come to now split these figures to each of those days, I might be splitting beyond or less than the stipulated amount. So that is why I had this checking, summed up all the allocation of my percentages to make sure that I arrive at 100%. Say if now I have, say here now I have a 12%. You can see that I have a 102%. And if I have a 102%, if I did in setting out, then you see that I have 102%. I have 140,000 in excess. I have a 140,000 in excess of the 7 million that I'm expected to have as my income. So you can see I have a check here, a control here that shows that this place will tell me that uh, your figure you've allocated is beyond the 7 expected income. So I will now go back to see where the problem is in my percentage. And once I change it, I'm having 100. You see that uh, there are no figures indicating here. So as a quantity surveyor, even as a programmer or as a project manager, when you're preparing documents, there's a need for you to put measures of control that will check your figures to ensure that you are accurate in all of your analysis. So having prepared this having apportioned the quantity according to my expected activities for each of the day, I now I now multiply the percentages each of the day by the income, the total income I am expecting from the client for each day based on these percentages. As you can see in the preliminary item, which is the first one, I did set on in my planning that I have 3 days to mobilize to site. You know, the preliminaries is divided into 3 categories. You have the initial expense, initial cost, then you have the running cost, which is the recurrent, the one that the recurrent that has to do with the indirect staff salaries, the diesel, everything that needed the site to function, that you needed to consumables generally. You needed to spend always at the end of the month or at the end of the day. You need to pay the engineer, you need to pay the security, you need to pay the storekeepers, you need to pay all those staffs that are not directly involved in terms of say executing the job, say masons, carpenters, and all those are the direct workers. But the indirect workers are those that are on though very important people to the project, but they are not directly involved in the construction. They are the administrative staffs, engineers, project managers, production managers, all inclusive. So I, in my focus, I said there's a 10%, 10%, 4%, then all through I spread in the 2%. You know, the workers are not employed all they are the total workers expected, anticipated, the indirect staff that are anticipated to work on that side are not employed on day one. They will be employed as further work front is expanding. Then you now start bringing in more foremen, more headmen, more storekeepers to ease the job and to have a smooth running of the site. So that is why you see I have a 4%, 2%. Then as the work is speaking, there's a 3%, there's a 3%. Then once you get to the end, because you are demobilizing, you need a lot of trucks to move in your equipment out of the site. There's a 10% and a 5%. So this is the same percentage I use now to allocate these figures, the figures I have here as my income. As you can see, the total income, the total project cost is 130 million, and I have a 130 million here, and the total project cost of the project is a 130, and that is what I have splitted. And for me to check if I am actually correct, I summed up the whole money, the whole amount income I'm expecting on day one to now see, and I'm having the same 130, 300. So now it is assumed, let's even assume these days are now, we are now assuming they are months and I needed to put in invoice. So which means in month one, I'm expecting to take a 4.3 million for the activities, the work I have done in that month. Or even though if the project is a daily paid job that you needed to be paid as soon as you finish, I'm expected to take it 4.3 million. Then for day one, 5.7 day two, 6.15 day three, 5.8 day four, 6.3 the five, like it goes on and on till day 35. Then if the project is a project that the contract stipulate that you are entitled to a 15%, say an advance payment of a 15%. So you'll be given a 15%. And once given the 15%, it is expected of you to pay back, amortize this 15 this amount as the work progresses. And there are different ways depending on what the contract stipulate. There are contracts that will tell you for every job you do, you ought to pay a 15% equivalent to the 15% that was given to you. Say I have done a 4.3 million job, I'm going to pay a 15%. I'm going to pay 15, whatever the value, whatever the percentage is. That is now I have yes, I'm going to pay 15% to it. Or there are some that will say, will give you, there is a condition that will say, whatever the percentage of your activities, that is your production on site, in relation to the total contract value is what you are going to be paying as amortization on the monies that were given to you. So that is what you see here. I divided the amount that I worked for, that I'm invoicing, to the total figure that the total contract value. It gives me a 3%, which means I am going to amortize 3% of the advance payment to the client, and that is what you see. I have multiply the 19 million by the 3%, which is the percentage of what production that I have done on site, to give me 645,000, which they will deduct from this, from this amount, to give me what I will be getting as net. So now, and that is how it graduates. You see, we have the 5, we have 6, we have, where the figure is big, you have 6% all through the project. And this figure must be 19,500,000. So it is a 19,545,000. So meaning that it is correct. At the end of the project, day 35, I should be able to pay back my 19 million that I took from the client. Then for my purposes of the treasury, how much are we having in treasury in each day? So now I have a 19 million that was given to me. I have a 4.3 million that I have worked that will be paid to me. Then I have a 645 that will be deducted from this amount. So in my treasury, in my account, I should have 23,220,000 in day one. Day two, I have done the same I have done a 5.4, a 5.7 million, and a 4% is the value of 4% of the total contract value. Is the amortization is 862. Then deduct it from 575. I have 488. Add that 488 to 2.23,200 will give me 28. So what I did with the last cumulative rule is to add the preceding month or day value to the next day value, so that at the end I should be able to have my 130, which is this figure. Meaning that if this rule serve as a check as well, to ensure that all my income will arrive at 130, which is the contract value. So having explained this table, if you are working in a reputable organization where you have hierarchies, very senior management that will not have that time because of their schedules. They will not have that time to go through all of this analysis. You are expected to either summarize this the whole of this analysis either in using a chart or other means to reduce the document to just him glancing and seeing what the document is all about. So for the purposes you can use chart, and that is what I just I had to do a bar chart here below that at a glance, rather than him going to interpret all of these uh, figures that is say cumbersome because of his engagement. He will just come down here. He just see how the income will be reached and will come into the coffers of the company. Okay, in day one, that is the day I'm going to have the highest amount of monies in my coffer. I'm going to have about 23 million, in my coffer. Then day two, I'm going to have a little less than 5 million. Day three, I'm going to have slightly above 5 million. Then day four, I'm going to have something a little less than 5 million. So you could just see at a glance. So having explained this, let us quickly go to the expense forecast. The difference between the income and the expense, every parameters remain the same. The planning remain the same. The difference is these figures. It is these figures that is for the expense, because this figure is less the profit and the overhead. This one is less the profit and the overhead from the income. So this is the figure that I now distributed. I distributed according to the number of days, 35%. As you can see, I have a 96 million. I have a 96 million here, which represents the 96 million that is in my expense, while the 130 million represents the 130 million I have here. So now the same principle, the same logics that I use in distributing the figure. So the last document now is me using the two documents, that is the income forecast and the expense forecast, to now prepare my cash flow. What I did in my cash flow is just to marry the income, and the expense. And what I just did is just to click here, and I'll go to my income. I'll go to my income. I'll drag the same thing. I go to my expense. I drag. So I have just linked the two documents and the figure tape. So after linking it, then if you remember in one of the episodes I did where I did explain how to prepare budget, and that will now translate to you now applying your markup that will now give you the bill rate. And in that episode I explained how overheads overhead and profit is generated, and I did told us there that the amount in the overheads, they are part of your expense. They are not profit, because the thing that constitutes the expense are your head office charges, the staffs in your head office, the vehicles at the head office, the consumables they use to run the affairs of the head office, the insurance costs, the cost for bond to secure your advance payment, your defect liability, which is a cost you will incur because you are expected to stay after 6 months, depending on what the contractor says, for you to attend to most of the defect that will appear within those period. So this is money that you're going to use to take care of it. I did talk about technical risk situation. You are digging, you are constructing, and you have some challenges where the columns shifted from alignment. You need to pull it down because the client has insisted you have to pull it down. You needed to provide some contingency costs that you will draw from that amount to take care of such a kind of eventuality. So uh, those costs, you have to factor it into your expense. And that is what I have here. I have my overhead costs. I assume 18%. I assume 18%. It's an assumption because everything I am doing here is an assumption because there are no, uh, I am not basing it on a specific document that I will refer to or budget that I have prepared, and I'm now translating it into this document. So now I have an 18% of the cost of my expense, which is going to be my overhead cost. So now, which means my total expenses is going to be 3.7, while my income is going to be 4.3. Then in day two, my total expense is a 5.7. Why 5.7? Why uh, my income is 5.7? Why my expense is for 5.5 million and some few fraction. So with this document now, once you give this document to the finance department, they know that on day one, they need to make available 3.7 million for you so that the job will not be delayed. And they will be expecting, after you have executed this portion of job, the income that will come in will be 4.3. In day two, you expected they will make available a 5 million. So this will now tell them, at a glance, will tell them, okay, you need a 113 million, for for you to execute, the whole of this, the whole of the job. You need a 113 million for you to execute this job. So either they will make the whole 113 million available, or they want to take it month after month. They will now make sure that they'll be following this planning to make sure that you have all of these figures uh, kept for you, so that you can execute your job appropriately. Then there is no finance that is an idle money. Money is cost. Uh, then I further uh, advise, or I further expatiate, or point to the finance department that though I will be expecting, I'll be needing a 3.7 to execute this job, and there'll be 4.3 a 4.3 million that will be coming in. And if you deduct 4.3 from 3.7, you are going to have a 41,000 in your offer. So rather than you keeping this money idle, if I don't have a site where I needed to channel it to, I'm saying that if I am dealing, this is my project, I'm the project manager now, I am telling the finance that I am still going to make further profit with the monies left in my treasury, which will further boost my markup, the profit that I'm expecting to turn out at the end of the project. I'm saying that this value that will be kept idle in my account, since this is the amount that I will be I'll be receiving after executing this out, fix it for me. Let's say at whatever percentage, say maybe if it is a 12% a compound interest rate. So if it is a 12% compound interest rate, then I'll be having a 5,000 every month, because the 12% is for me to divide the 12% by 12 months. By 12 months, they will now give me what the percentage that I will be getting per day. Let's assume this is a month. These are months now. I'm just assuming these are months. Now, this figure, or let's even assume it is day. Say if, okay, this is a compound interest of, say for 30 days. Let's say for 30 days. And per day, I'll be getting the 5,000 in addition to the 41,000. So at the end of the project, I'll be reckoning 3 million in addition to, I'll reckoning 3 million in addition to the profit I'm expected to make for the monies I have kept in bank idle that I fixed. So I'll be making 3 million in addition to my profit. So after all of this exercise, just like I did said, some some top managers will not have the time to go through your figure. You prepare a chart. I prepare a chart for the expense and income that will show. As you can see, the green uh, is the income, while the purple is the expense, and it's telling me that it's showing that by the expected income is more than my expense. Anticipated income is more than my expense. You can imagine if my expense was more than my income, automatically it will tell me that it will already indicate that there is something wrong either with my analysis or with the entire project. So please, if this exercise, this lecture, I've been able to further enlighten you on how to prepare your cash flow, please do like my video. Above all, if this is your first time of coming in contact with my video, please subscribe, drop a comment, questions, wherever you want clarification. I'll be ready to attend to your questions. Thank you. See you in the next episode.